Welcome back to Squawk Rock. Just some breaking news. February read on PPI, January preliminary on durables. Headline, PPI up 0.1%. Strip out the all-important food and energy, also up 0.1. Both are half the 0.2 expectations. No revisions, but just to refresh everybody's memory, last headline was down 0.1. Let's look at year over year. Final demand 1.9 as expected, 0.1 light ex food and energy year over year, 2.5%. That's a little under expectations, which were identical to our last look at 2.6 on year-over-year trade, up 2.3. Let's get to durables. Remember, this is preliminary. It's volatile and it's final. So the preliminary definitely has an asterisk, expecting down 0.4. Take a look in the mirror. We reverse that to up 0.4 and gain 0.1. On our final last read, which was up 1.2, now stands at up 1.3. Once you take out energy, though, transportation, it does drop negative. Drops down to minus 1.10. So we could see that aircraft transportation orders skewed the data a bit. And if we look at non-defense orders, ex-aircraft, that is up 0.8. That is pretty good. Anything a positive number. We've been looking at negative. This is the seed corn capital spending. It's been a big issue. Our last look was down 0.9. Now, if we switch from orders to shipments, solid, up 0.8 as well. We still have construction spending to come out at top of the 10. You know, we're hovering in the low 260s in Treasury yields, a handful of basis points away from testing basically levels we haven't seen since January of last year. Let's call it 14 months, shall we, Andrew? Back to you.
Okay, Rick, thank you for that. Steve Liesman's on set with us, pouring through the numbers himself and making faces as he sometimes does. What are you thinking?
I'm thinking we still have a puzzle as to the reaction of corporate America and business to the tax cuts, to the decline and then the rebound in oil prices. All of that gets mixed in trying to understand what's happening with business spending, which is key here. We've had very, very, what's the right word, negative new orders of capital goods over the past several months. It was down 4 or 5 months. This rebound is welcome. Now, I've got another chart up here that I know it's a volatile-looking chart, but it gets rid of the other volatility, which is the quarterly chart looking at what's in the GDP accounts. There's two things are happening here. One is you can see the downshift in equipment spending, which oddly happens after the tax cuts, but does follow a decline in oil prices. What you do see there is a very positive response on the intellectual property, which is about 30% of all business spending. That's software, that's artistic rights, that's other things. Now, Barry Knapp, who I talk to on an almost daily basis about this, because we're trying to understand what happens here, and he's very positive on the outlook for the tax cuts. He says this is where you would expect the response, because he said the equipment numbers shouldn't be helped because we had already 50% expensing. The change in the tax cut for equipment wasn't big. He says it was bigger in the software component, and that's where you would expect to see it. So guess what? We don't have monthly data on intellectual property. We have quarterly data. So you've got to wait until. But anyway, I think this is in line. We had a nice bounce back this month. It's good to watch on the new orders. Shipments were also pretty good. We don't know if it's just a bounce back, but we're watching the intellectual property over time to get the totality of the response of business to the tax cuts. And so my verdict is the same. The jury is still out. You have to remain hopeful that there's going to be some response that's going to help GDP.
In terms of the PPI number, though, that feeds into the narrative of no inflation and yet rising wages, and that is a pickle that corporations find themselves in.
Okay, that is right, except for one thing, which is the softly rising or almost barely rising at all PPI is good for business in the light of the wages, because the PPI are the input costs.
Right.
The trouble they have are the consumer prices, which they're having difficulty passing along these prices. So we've talked a lot about this. There are only three things that can happen. One is that their profits have to fall, and that's what you see when you look at the earnings coming down. Two is they can raise prices, and we don't see that in consumer prices. Three is that they can enhance productivity to try to get rid of all of that. So we're watching. You can't make a blanket response. Every company's going to react differently. They're going to move to try to protect their profits, either through raising prices or boosting productivity. But the wage thing, which is people are talking about the tight labor markets and these stronger wage gains, they're definitely a reality right now.